Okay, so the question was, assuming we correctly recognize revenues and expenses for both quarters, with all magnet sales in quarter two, but all magnets produced in quarter one, of course, what would be the revenues, expenses, and income added from the magnet in quarter one? So the first thing to remember here is that according to the matching principle, we can only recognize the expenses of a product when we realize the benefits of that product. And that can be in terms of using the product, or in this case, selling the product. So we have 1,000 magnets produced at $2 each in quarter one, but none of them were sold in quarter one. Therefore, we have revenue added of $0. And since the revenue added is $0, the expenses added are also 0. And our income added for quarter one is, of course, 0. Quarter two is a little bit more interesting. Here we actually sell the magnet. We have to figure out what the revenues are. So we will go $3, which is the price of each magnet, times 1,000 magnets. And we will get revenues added of $3,000 in quarter two. Moving to expenses, we didn't actually spend money on producing magnets in quarter two, but we know how much they cost us in quarter one. The rate was $2 per magnet times 1,000 magnets, and we will have expenses added of $2,000. So recall, the income is revenues minus expenses. So 3,000 in revenues minus 2,000 expenses give us income added of $1,000. Let's look at a different example. Note that the revenue and expenses are increasing together as we expect based on our criteria. Now let's assume half of the 1,000 magnets we produce in quarter one are sold within the same quarter, and the other half are sold in the next quarter, in quarter two. Assuming we correctly recognize revenues and expenses for both quarters, what would be the revenues, expenses, and income added from the magnets in quarter one? So what I'll do here is I'll pause for a minute and you can have a look at not only the quarter one numbers, but also the quarter two numbers down here. So I'll stop for just a minute and give you a chance to work on this. So we're going to calculate the revenues of half the magnets selling in quarter one. So it will be $3 per magnet times 500 magnets. So half of the 1,000 were sold in quarter one, and we'll get revenues added of $1,500. Now looking at expenses, Once again, we're going to recognize the expenses for half the magnets. So $2 per magnet times 500 magnets. And this will give us 1,000. And finally, we can go ahead and calculate net income again, or income added. $500 is added in quarter one as a direct result of selling half the magnets. Looking at quarter two, well, there's nothing too tricky about this, since exactly half the magnets sold at the same price, we will have the same number for revenues, and $2 times 500 magnets give us the same number for expenses, resulting in, once again, income added of 500. So essentially, what has happened here is the income or benefit has been split between the two quarters, since half the sales activity happened in one quarter and half the sales activity happened in the second quarter. And this is all despite the fact that all the production activity happened in the first quarter. Here's an interesting question. What should be reported as ending inventory for the magnets at the end of quarter one? Well, ending inventory just means what did you have on hand. In this case, since everything was produced in quarter one, it's going to mean everything that we didn't sell. So we produced 1,000 magnets. We didn't sell 500, right? Those were carried over to quarter two. So therefore, at the end of quarter one, we had 500 magnets in inventory. And we can also express inventory in dollars. And according to historical cost principle, we should record cost or report cost at the price that we bought the magnets for or produced the magnets for. In this case, we produced them for $2 each. Therefore, the value of our ending inventory at the end of quarter one is $1,000. Let's move on to a more complex approach to expense recognition. Imagine that the bookstore has an option to save money by paying for 6 months' rent in advance. By paying $6,000 in January, the bookstore would not have to pay anything else until July 1st. Should the full $6,000 rental expense be included in quarter one? Once again, the answer is no. We must calculate how much of the $6,000 of rent we used up in quarter one. So you see this calculation here. 6,000 is a total number that we paid on January 1st. And then we have a prorated formula, 3 months in quarter one divided by 6 months total paid. So if you were to divide 1 year into 4 quarters, which is what a quarter is, each quarter would be 3 months. So in quarter one, we would have January, February, and March. So we paid for the first half of the year. Only 3 months belong to quarter one. So 3 out of 6 is what we use to prorate the 6,000. So that's essentially half. So 6,000 times half results in $3,000 of rent used up. So we have only used up half of what we paid up front. So we should include $3,000 of rent expense in our quarter one financials. So what happens to the other $3,000? The rent we have already paid for the next 3 months is prepaid expense. In this example, it will be shown on the asset section of a Q1 balance sheet as prepaid rent. This type of item on the balance sheet shows users that a firm will realize future benefit from expenses they've already paid for. We will discuss this concept in more detail as we cover deferrals and accruals on the next page. So accrual basis accounting, it records the effect of every business transaction as it occurs no matter when cash receipts and cash payments occur. Accrual accounting is based on the time period assumption and recognition criteria for revenue and expenses. As a result, it is a common accounting method used by Canadian businesses since it meets IFRS, ASP, and CRA requirements. Cash basis accounting records transactions only when cash is received or paid. Receivables, payables, and other expenses, such as depreciation, are ignored. So in this course, we're going to have a much stronger focus on accrual basis accounting because, generally speaking, the correct way to do things. Just because we don't have cash flow doesn't mean that something doesn't happen. So in this course, we will lean towards recognizing everything that happens. With that said, I am going to stop this video here, and we will continue on in the next video with adjusting entries.